Hey there, it's Keith Hoffman with Draper and Kramer Mortgage Corp, and I'd like to welcome you to the first time Home Buying Basics webinar. It's brought to you and sponsored by Employee Solutions Group, Sandra Price, and I wanted to welcome you and inform you about all kinds of wonderful things when it comes to being a first time home buyer. So let's get right into this, and I think we're going to do this. Oh, here we go. So here's the topics that we're going to talk about today. Home buying process itself. We're going to talk about what the mortgage professional and their role in purchasing a home. When's a good time to buy? Credit issues or credit concerns and mortgage process itself. How to qualify for a mortgage and the loan limits. Types of mortgages and different specialty loan programs. We're going to look at parts of the purchase contract, and there's pieces in there that are going to be really important for you to know about, but it's not going to be something that you need to be really concerned with right now. We're going to talk about free credit reports, and we're going to talk about opting out information. And then the last thing we're going to talk about is benefits and a phone app that's available to you that you can use when you're at home, out and about, whether you want to look for homes, run a calculator, do all kinds of things. So the first thing I want to talk about is the home buying process. The home buying process really starts with a real estate agent and a mortgage professional. Basically, if you went to a real estate agent, they're going to say to you, thanks for coming. Do you have a mortgage professional? Do you have somebody who has pre-qualified you or pre-approved you for a mortgage? What price range can you be in? And without talking to a mortgage professional, whether it's a mortgage banker or a broker or a bank, then you're not going to be able to tell them. So really, it's good to start with either one, but you're going to end up talking to the mortgage professional before you really figure things out. You're going to go through the whole process. You're going to search for a home with the real estate agent. You're going to make an offer and negotiate through that agent. Once you're under contract, then you're going to get a home inspection in the property, and you're going to go through the mortgage application itself with the lender. And it's all going to culminate with the closing of the property and able to get that home of your choice. Now, the one thing that I wanted to show you is this is the actual buying process. So the first thing you need to do is you need to organize your documents. And I will have a list of those things for you shortly. But once you have those documents, you'll be able to get pre-qualified from a lender. Lenders are going to go through with you all the information, make sure your credit is run, and see exactly what you would qualify for and what your best products are. Then you'll go looking for a home with your realtor, and your realtor will put the offer in for the home that you like, whether it's a townhome, a single family, a condo, multifamily. And once it's accepted, that's when you're actually going to go back to the lender and do the full application for the mortgage. Now, at that same time, you're going to be going through some things in the background. You're going to talk to an attorney because they're going to look at the contract to make sure that everything is going to be in order. And secondly, you're going to need a home inspection. And a home inspection really protects you so that you know all about the property itself. If you have a property, if you have a home inspection, it's different than a home appraisal. And the appraisal is going to be done by the lender. They're going to appraise the property based on value, but you want to know the things that are going on in the house. During that time, your loan will get approved. Once you're ready to close, usually the day of the closing, you're going to walk through that property with your realtor to make sure that that property is still as you bought it, as you first looked at it. And then you're going to go to a title company or an attorney's office and you're going to do the closings. That's where you sign all the papers. Now, the actual process works this way. As I mentioned, you're going to meet with the lender and get pre-approved. You're going to find the home and place the offer with your real estate agent. After it's been accepted, that's when you do the full application, bringing all the supporting documents if you haven't given them to them already, and then they will go through the documents with you. Now, all lenders need to tell you what the estimated cost is. So you get to know what you need to bring in for closing. And that is a loan estimate. The lender has to have you sign it within 3 days. And there's also a intent to proceed. That's a document that says, yes, you've looked at the loan estimate and you want to proceed with the mortgage. And that's how that works. The lender's going to take all those documents, put it together, order the appraisal, and send it to underwriting so that the underwriter signs off on the guidelines that you've put in for. Before you close, you're going to sign what they call as a CD, closing disclosure. And this has to be signed a minimum of 3 days before closing. The government put that into effect so that lenders cannot pull a fast one and say, you know, here's what it cost, and then all of a sudden you go to closing and it's $10,000 more. So these are the kind of things that the lenders have gotten or been given by the legislation, and we don't have any control of it. So there is no really fast closings if you don't send out the closing disclosure on a timely basis. Now, working with the professional. I want to tell you, these are the pieces or the professionals you need to be working with. The first is a mortgage professional. We're all licensed. If you're not licensed, you can't do mortgages. And you need to work with a reputable mortgage company or a bank. Their role is to help you identify the loan product for your situation, not for anybody else's, and then qualify you for that program. They're going to take all your documentation and your loan application. They're going to work it all and make sure that you do qualify. So they're there with you from beginning to end. It's also the obligation of the lender to order the appraisal and work hand in hand with your real estate agent and the attorney to make sure everything is a smooth transaction. Now, there are 3 types of originators. The first is a bank originator. And bank originators, they loan the money of the bank themselves. So they're going to follow the bank policies of whatever program that the bank has. So if it's a 30-year fixed mortgage and they underwrite it to Fannie Mae or Freddie Mac guidelines, they are the ones that they're going to give you that information. And their rates are based on their bank only. The other 2 are the mortgage broker or a mortgage banker. And people always say, oh, good, you're a mortgage broker. Well, mortgage brokers are a little different than mortgage bankers. Mortgage bankers have a financial investment in this, and they're in full control from beginning to end. So what they do is they have investors that they sell to, and they will sell, the bigger they are, the better pricing it is. So if you have somebody like a mortgage banker, we're a mortgage banker at Draper and Kramer. So basically what you can do is I can shop between all the banks and lending institutions that are buying these mortgages. And because we do so much volume, we get great pricing, which in turn we give to you, the consumer. Now a mortgage broker is a little different. They're sort of like a banker because they shop between all these lenders, but they don't have a financial relationship in this, meaning that they don't fund it themselves. They don't order the appraisals themselves. The end lender that they're going to broker it between is the one financial institution that will make those happen. And based on that, you will probably get better pricing from a mortgage banker, especially one that does a large volume of business. Now, what do we do as lenders? I think I mentioned to this. We're helping you identify the mortgage products that fit your needs. And I always specify your needs because it's really important for you to know that once we tell you different products, you need to tell us what fits your lifestyle best. For instance, some people are more conservative and say, I don't want an adjustable. I want a fixed rate mortgage. Or somebody might say, I'm only going to live in the property from 3 to 5 years. So I'd like to get an adjustable and get a lower interest rate. Those are the things that are shown to you as a consumer, and then you need to choose which product is best for you with the help of your lender. They're going to talk to your agents. They're going to tell your agents the purchasing limits of what you can do based on your conversation and qualifications. And then they're going to take the application. They're going to order the appraisal. They're going to submit it to underwriting. And in that same time frame, they're going to be in contact with your attorney, in addition to your real estate agent. They're going to coordinate the financing with the title company, and then the title company will be the in-between person. That'll be like the place that you go to. Everybody's going to get there, and they're going to represent the sellers and the buyers. They're going to be the middle person, make sure everybody's doing the up and up, and they're going to make sure that the money comes in and out, and they're responsible for certain things too. Now, the real estate agents are the ones who are going to help you identify the properties and negotiate for you. And they use a super system called the multiple listing service. It's the MLS system, and what they do is they can plug in all the details that you're looking for. $300,000 house, 3 bedrooms, 2 baths in Downers Grove. And they'll put that into the system, and then based on that, it'll come up all the properties that are based in the MLS or listed in the MLS, and they're the ones that they can show you then at that time. The home inspection, as I mentioned, is a little different than the home appraisal. So the home inspector is going to go into the property and make sure that every single thing is looked at and identified, whether it needs work, it's old, there's a problem with it, and most of them do that, and then we'll give you an idea on pricing. So some are important to do right away, and some of them are not really important. They're not here to give you, like a whole laundry list of things that absolutely have to be done. But they will mention this is a hazard, or the electrical is not right, or doesn't meet code, things like that. Now, I know when I bought my place, I had a home inspector, and I'm not getting into the attic and trying to look at different things, but they do, and they found mold in the attic, which then in turn had me ask the seller to get it remediated, which means getting it fixed. So they did that, and once they got it fixed, then I got the information that it was actually fixed, and therefore I was okay to buy it. But I would never have known if my home inspector didn't go up into the attic. Real estate attorneys, I'm going to emphasize real estate. You don't want Uncle Joe coming out there and doing a home transaction for you if he's not experienced in real estate, because they're going to make sure everything is done right on the time frame. They're going to look at the contracts and make sure that they're done, that the lender is doing their part. They're making sure that the seller is doing their part. It's just really important because they're going to represent you at the title company, and they want to make sure that every single thing that you need as a legal right, that they take care of. Now, I always have a question: when and where should I look for a home? And the number one thing that they want to do is they'll look at it and say, well, I'm considering buying a home, but can I afford this? And my answer is always this: you have to look at, is this the right time financially? Are you okay? Can you make the payments on time? Where do you want to live? You're going to look at, well, let's see, if I work in Chicago, do I want to live in the suburbs and and take transit there or drive there? Or do I want to live closer and potentially, at a higher cost, but yet it's your lifestyle? How much is the whole thing going to cost you? And what are the benefits of buying versus renting? So when you're looking for this, it's really important that you do your homework ahead of time. You can go, and I'm not a big fan of this, but you can do the best mortgage loan companies. You can go online and put that in. Everybody has a little different criteria of what's the best mortgage company. But basically, what type of home are you going to be looking for? So you can look online with lenders. You can go to somebody like us at Draper and Kramer, where I have my own app. So you can download the app and you can actually get pre-qualified on it, but most people don't do that. They can do a home search on it, so it goes right through realtor.com. You can do it sitting in your home at 10 o'clock at night or 2 o'clock in the morning if you're really tired, can't sleep. And then there's a lot of different things, like if you have children, do you want to find a good school? So you can plug that in. There's a lot of additional things that are on this app that are very good. So mortgage companies do have apps, but you need to do your homework. And you're going to look at lenders. You want to say, just because they have the best, lowest price, are they the best consumer rated? Do they do a good job? Do they have any issues or problems? And most of the time when you talk to a lender, you look at them face to face or you talk to them over the phone, you can get a pretty good feel of whether they are right or wrong, whether they're honest or not. And then the best way to go is your personal referrals. As a family member or as a friend, gotten a mortgage from somebody, have they had a good experience? That's a great way to go. Now, I always run numbers, and you can do this yourself. I have a different program that I think I can help you even better than this. But let's just say you wanted to do this. So you can go to my app, dkmortgage.com/mortgage-resources.php. And you can actually run these things and run the numbers for yourself to see, well, how much you want to spend in monthly rent, how much is it going to go up every year, how much is insurance going to be, and so forth. And you can compare that to owning a home. Now, what I'm going to suggest to you is, if you want to play with this, that's fine. But it's much easier for you just to pick up the phone and call me, because I have a great program that I would like to show you briefly and exactly what it does. So here's what I did here. I can create a program here or a report for you. So I just put in DuPage County. I put in 60515. And what it tells me is the median price of that homes in that DuPage County is $334,130. It's going to give me the historical background as far as how much it's gone up in the last 5 years, 10 years, 60 years. You can see it's 5.43%. 10 years, only 1.17. Of course, we went through a major problem in the late 2009s. 60 years, it's been 4.45. But this program is wonderful, because what we've done is they've taken 150 of the top economists, and they've all put in their information. And now the forecast for the next year in DuPage County, it's going to go up 1.68%. So if you're going to live there for 1 year, it's not going to be worth buying a home. But 5 years is a little different. It's 17.5%. So you can see over here the first year and the second year, because you bought it for $334, how much you're going to have in equity in your home. So in 5 years, you're going to gain $58,711 in equity. Now, what's nice is you're also going to have additional equity in that property, because, let me go back up here. What this is going to tell me is, and I'm going to go to a different program to show this, there's 931,000 total population here, and of that, 219,000 of them are renters. So if you're on this program or on this webinar right now, you're one of those 219,000 renters. 58,000 of you can actually purchase a home based on your income and your credit, which means you have a lot of opportunity. Now, annual potential first-time home buying, there's 22,000 of you. So anybody that's between the ages of 27 and 35 in DuPage County, there's 22,000 potential first-time home buyers, and the annual new homes that are needed to meet them are 10,000. So you can see that the ability for you to buy a home is going to be good, but yet you're going to be competing against other home buyers because there are less homes than potential buyers. They only actually built 1,508 homes, so obviously they have a lot of homes that are going to be on the market that are going to be for sale. What's nice about this program is if you called me and you had me do this, you can see the unemployment rate. And obviously, the unemployment rate has gone down in DuPage County, which is very good. Because if you have a property that's in a location that unemployment goes up, potentially the values are not going to be there. They'll show you the affordability and the total employment, but at this point, this is really important because in our area, you can see that the median home price is $95,000 and the national average is $54,000. So we are higher, and so you should expect higher prices than if you were buying in Arkansas or Louisiana or something like that. The other thing about this product is, so $334,000. I can go now to my rent versus buy, and I'm going to put in $334,000. So $334,000 for a value. And I'm going to load it up, and I'm going to put it in for Illinois, and I'm going to go back to DuPage County. Where is it here? There you go. And it's going to show me whether it's good or bad to buy, and is this a good time to buy. So you can see a comparable rent for this property at this price range is $2,177 a month. It's $33 a month in renter's insurance, and it usually goes up about 3% a year in the cost to rent. So let's go over here. If you're renting in year one, it costs you $2,177, and it's going to be $33 a month for your mortgage or your homeowner's insurance, and you don't have any maintenance to pay because obviously you don't own this property. Now, in 9 years, it's going to go up, and therefore your new payment's going to be $2,800. If you bought today, and I think we put in 4.5%, and the APR we show as a higher number, and we're not usually that high, but depending on what you're going to put down as far as down payment, that might fluctuate. You can see $815 in property taxes and insurance, and we always figure how much you're going to put in for maintenance because you are going to repair the home every year. So we figured out what it costs you for the year, and this is the maintenance per month. So we just divided it by 12. So what this shows is if you are going to be there for 1 year, 2 years, 3 years, 4 years, 5 years, you are going to lose money if you bought a home because you can see what this cost is for rent. So the cash flow difference is $3,916. But what this does show me is your appreciation in your home is going to go up $130,568. When you make your mortgage payments, part of it goes to principal, part of it goes to interest. So if you were there for the 9 years, you're going to gain $52,586 in principal. Therefore, you are going to make an additional $144,684 in 9 years. And we do this for 2 reasons. One is there's a cost here to sell your home. So obviously, if you're paying 6% to the real estate agent, and that's approximately what it cost, and it's based on this new value because the values have gone up, that percentage that they showed, there is no tax benefit there, 0. Standard deduction is only $24,400 in the 22% bracket. So if you were there for that amount of time, this is how much money you're going to make. So if you were going to ask me, is this a good time to buy? My question is going to be asked to you, how long are you going to be in the property? If you're not going to be in there for 5 years or more, then it's not worth buying. You need to rent. Okay? So these are the kind of things that we can do as a lender. I can send this to you via email. You can make changes to it. We can make changes all the time. So I just wanted to show that to you so you have an idea of how we can figure things out in comparison to you running these basic numbers. Understanding the mortgage process, these are the things all lenders need to look at to get pre-qualified. We're going to look at your income. Okay, that's the most important thing. Well, it's not the most important thing, but it is one of the most important things because we also need to look at your job history. How long have you been on it? Are you employed? Period. Your ability to repay your debts. So we're going to run your credit to make sure you can make your payments. Do you make your payments on time? Available cash to work with. How much do you have? You know, I've had a lot of people say to me, I've had $20,000 I want to put down. Well, my question then is, do you have another $5,000 that you want to, can use to do your closing cost and prepaids? And I just threw out a number, but, there are different numbers and different ways we can get to things. But I always look at the available cash to work with. And then your credit scores and credit history. Do you have good credit? That is very important. That will dictate a lot to the lenders in pricing. When we look at income, we look at income in all different ways, but you have to have a job, period. We'll look at it whether you take a salary, an hourly wage, whether you're commissions, do you get overtime? Some of you are self-employed. Are you unemployed? Now, people can get a job. They can still buy a home if you've been unemployed, but you have to be employed when you actually buy your home. I'll get into that in a minute or two. And then, do you have a part-time job? We can use a part-time job. The other thing is we look at a 2-year history. Now, the first thing I will tell you is college counts as work. So if you just got out of college or you've only been out for a year, that's okay. All we need is a diploma or a transcript, and that will count towards it. Unemployment does count towards it as long as it's within the time frame of the 2 years. So we have to document those things. Job gaps, we need explanations for that. Second jobs are counted. So as long as we have a 1-year history of that, we can use that. And again, each of the guidelines are a little different. And then the question is it in the same job line or not? And you don't have to have a second job that's in your same business. Funds to use. So we look at how much money you have. And the key here is trailable funds. So we look at, you can use a checking accounts, savings accounts, you have money markets, retirement accounts, gift money is acceptable. If you have any stocks or bonds, money markets, brokerage accounts, those can be used. And seller paid closing costs. So you can talk to me a little later about it when we pre-qualify you on how the seller can pay your closing costs for you so you don't have to come up with the money. But the key is trailable funds. Credit scores. This is probably one of the most important things because that's going to dictate to us and the banks exactly what adjustments are going to be made on your rates. So for instance here, and I laugh because when you look at this, most of the people think, well, red is bad and green is good. And the way I look at this, the red hot buyers are the 700 to the 850s, and the people that have problems are the lower under 640 scores. But we're going to look at, and all of these are based on your monthly obligations and your total debt, your payment history, whether there are judgments or collections against you, and they're all going to dictate everything when it comes to rates and cost. So here's what actually goes into your credit reports. 35% goes into your payment history. So when you make your on-time payments or little or no payments, late payments, you have a better score. 30% is credit usage. So you want to be below 50% of your line. So if you have a $5,000 credit line on a credit card, you want to be less than 25 or 50% of that as your balance. And you don't ever really want to go above it because when you do, your scores come down drastically. The length of time, how long have you had it? Credit cards, the longer it is, the better it is. So you want to build good credit for a long period of time. In addition to that, the number of credit cards, 10% of it goes to that. So what they do is into their algorithms, they build these things because based on your income, they want to make sure that you can afford what your credit cards are. And then the last thing is the inquiries into your credit. And what that does, every time somebody runs your credit, you're temporarily going down in credit score because what that indicates is that you are going to potentially have a change in your picture of what your debt structure is. Now, here's an example of how these two compare. So let's say, for example, interest rates are 5 1/8%, and you're buying a home for $300,000 and 10% down, but your credit scores are 640. So based on this, your payments are going to be $1,470 for the principal and interest. Now, as I mentioned to you, you want to have higher scores. So if you go over here and look at credit scores of 740, that same exact program has a rate of 4.5%. So basically what you're doing is paying $1,368 a month, or you're saving $102 a month on your mortgage because you have better credit. What that equates to is $1,224 a year, or $8,568 over a 7-year time frame. And that's really important because you would rather pay your mortgage down or have a lower payment than to have credit issues and pay a higher rate. And you have to understand too, I'm looking at these rates, they're not exactly where they are today, but when I did this, I compared somebody at 740 with a 4.5% interest rate, and what would the scores dictate to the new rate, and that's where it went to. So you can see it's considerably higher. What things are you going to pay for as an obligation for the whole transaction? Because you're going to need to know how much money you're going to work with. So you're going to earnest money. Earnest money is money you're going to put down when you purchase the home to give a good faith that you're going to go through this process. So it might be $2,000 or $5,000, and that will be applied towards all of the costs that you have. So you're not losing it. You're just going and putting it into a situation where it's applied to things in the future. If you went through this and you didn't get it, you potentially could lose your earnest money. The down payment is different, is basically the difference between what you're borrowing and what the purchase price is. If you're buying something for $100,000 and you're getting a 90% loan to value, you're putting $10,000 down, that's your down payment. All lenders are going to have fees. Each one of them are a little different. They will also include the appraisal and the credit reports. In addition to that, there are things called closing costs. The closing costs are broken down into two different things, closing costs and prepaids. Prepaids are things that you're paying for, which is title, interest on the new mortgage, and tax escrows. This is money that you're putting into an account to do the taxes for in the future. The other would be a home inspection and then an attorney's fees. So that's pretty much most of the things that you're going to pay for. So you have to make sure that whatever you're talking to with your lender, you have the amount of money that we can talk about for all of those things. I mentioned a little earlier about the loan estimate. And so this is a 3-page document. And pretty much what it does, the most important thing is right here. What the interest rate is, what you're borrowing, and what the cost is for the principal and interest of that. The other thing that's really important are these things over here, the closing cost, and these are estimated costs that are based on numbers that we have, we already know. You know, for instance, like if we did this as a company and it was $1,100 as an origination fee, it goes to admin, processing, underwriting. You can see that this is a total of the lender fees. These are things that you can shop for, but usually your lender does it for you. The appraisal, the credit report, and the flood cert. Those are things that are required on almost all loans. And then you have the services that you can shop for. So for instance, the title. And when you're purchasing a home in Illinois, you don't have the opportunity to shop for that. The seller's attorney chooses the title company, so whatever their company charges, that's what you're charged. This here is the escrows, the money that you're putting into your taxes and insurance, into your escrow account. And an escrow account is just something that's included in your mortgage that holds money for your taxes, your insurance, and your mortgage insurance. Then you do all the calculations and it gives you this wonderful number at the bottom, how much you need for closing. Now, one of the things that you need to know is this is a little difficult to swallow when you start looking at this. The key thing that you need to look at is the APR. This annual percentage rate is the interest that you're going to pay in addition to all the other costs that you're going to pay. That's the number one question I've had for 29 years of doing this. What's the APR? Why is it so high? Why is it different than the interest rate? Because you're paying things other than interest, and the government says you should amortize that over that time frame in addition to looking at what it costs you. So, for instance, when you're looking at something like this, with these actual costs, even though your interest is 4.5%, I go over here and it really equals 4.611. And that's how you can compare apples to apples. Somebody might say, well, I have a 4.25% interest rate. Well, then what is your APR? That's the next question. Because there's cost that you have. So somebody can offer you a lower interest rate, but higher cost, and the APR is going to be much different. Qualifying for a mortgage. These are the things that we're going to talk about that you need to prepare for your lender. W-2s and federal tax returns for the last 2 years. Now, if you're a student or if you've been a student in the last 2 years, you can get a copy of the transcripts or your diploma, and that should satisfy the other part of it. When you're doing some of the down payment assistance programs, then it's going to be a little different. So I will tell you that you'll need 3 years of federal tax returns instead of 2. You're going to need the last 30 days of your pay stubs, 2 months bank statements, and that would be all of the pages. Not even that last page that has nothing but advertisement stuff. It still has to be there. If you just accepted a new job and you haven't gotten to work there yet, letter of acceptance for the new position. And God forbid you've had a bankruptcy or a divorce. People have it. We'll need those papers too. Student loans. Student loans are they used to be looked at a little differently. If they were deferred for a long time, then we never had to use them in your ratios, but we do. So if it's on the credit report, we're going to use that. If it's not, we're going to look at fully 1% of the balance, and then FHA uses the fully amortized rate. So we'll look at the documentation that you give us. We'll figure out what the payment would be, and then we'll put that into your debt structure. Now, there's different types of loans, and the first thing you need to know is federally there are conventional and FHA and VA loans. Conventional loans are all the same as far as loan limits, with the exception of high-cost loans, and also different locations like Alaska and Hawaii, which are very, very high. So you can see over here for a 1-unit or a single-family home, in 2019, the loan limit maximum for a conventional loan was $484,350. Last year it was $453,100. So it's gone up considerably, which is really helpful to buyers because they can buy a bigger house with the same criteria of a conventional loan. If you are lucky enough to live in Hawaii, but unlucky enough to have to buy a home that's much more expensive, you're going to be a loan limit of $726,525. And I bring this up because there are high-cost loan areas. So if you're moving, for instance, to the Washington, D.C. area, or right outside of Alexandria, Virginia, those are places that have high-cost loans. So you can buy a home and actually get a conventional loan with much higher limits because they're much more expensive. In comparison, FHA mortgages, which are federally insured, the 1-unit property, the most you can borrow is $314,827. And you can see for a 2-unit, 3-unit, 4-unit, they do go up just as they do for conventional loans. But it's a little different, and especially in a high-cost loan area, you can now go to the same limits here as the conventional high loans. Now, in Illinois, or in all states, FHA goes by county. So no matter what county you're going to live in, you'll always want to talk to your lender to see what that maximum is. For instance, if you were buying in DuPage County, it might be 314,827. If you're buying in Central Illinois, it might be completely different. So the lenders have that information. We can pull it up at any time. Different types of mortgages. As I mentioned, there's conventional loans, which are, you probably heard of Freddie Mac and Fannie Mae. Those are the institutions that guarantee these loans. Conforming loan limit of 484,350, except for those high cost areas. There's FHA and VA loans, and the VA is only for veterans. There are jumbo mortgages, so if you go over 484,350, those are called non-conforming loans. They don't conform to conventional loans. They are jumbo loans, and they are different cost as far as, because they're higher risk, you're probably going to have a different interest rate and down payment requirements. In addition to that, there are lot loans. So if you're going to buy a home and put if you want to buy a lot and put a home on it, you can do that. And there are construction loans or rehab mortgages. So you can buy a house and fix it up, or if you just own a house and you need to fix it up, those are the kind of loans that they have. In addition to that, this is how it shows. So when you do a conventional loan, you're going to pay principal, interest, taxes, and insurance. And if you have less than 20% down, you have PMI, which is private mortgage insurance. And those are called PITIs. If you have a homeowners association, you're going to be paying that in addition. And through the automated systems that we have, if we put it into a conventional loan, you can probably go up to 50% of your debt to income ratio and still be able to buy a home. Now, it might not be your comfort level, but you can still do that. When you do the FHA mortgage, it's the same thing, except that their mortgage insurance is not PMI, it's really MIP, mortgage insurance premium. But I put this in as PMI so you can understand it's sort of the same thing. Their automated systems go a little higher, 54.99, but I've really never had anything go that high. 50% really is the high that most of them go to. And again, you probably will not feel comfortable with that if you're going that high. But there are reasons that we can go that high. For instance, let's say you have somebody that hasn't worked, let's say they're commissioned, your spouse is commissioned, and we can't use their commission because they don't qualify for that, but yet you know you're going to have that income. You may then feel comfortable when you get to that higher debt to income ratio. And that's why they still go to 50%. Now, conventional loans, you can do all kinds of loans. You can do conventional loans and put as little as 3% down. And any loans that have less than 20% down will have mortgage insurance. And again, that ensures the lender that you're not going to go into default. Conventional loans do allow borrowers to get money as a gift. So if your family member or uncle, aunt, cousin, spouse, fiance, they want to give you money to buy this house, they can do that. And there's a process that we work with that. FHA requires 3.5% down, and there will be mortgage insurance, as I mentioned, MIP, on all FHA loans. VA is a little different. We take care of our veterans. So what we do is the qualified veterans can do it with as little as 0% down. They have a VA funding fee, which is their upfront fee, and it's based on whether they've had their qualification, whether they've used their mortgage certificate yet or not. And then there is no monthly mortgage insurance. And both FHA and VA do allow gift money. So that's one of the things that's really nice. Now, when you're talking about mortgage insurance is not a bad thing, but yet it really goes to the lending institution, or not really lending institution, the private mortgage company, so that they're covered in case you have a problem. So when we're talking about some of these low-end, 3% down programs, Fannie Mae and Freddie Mac have these programs, and basically, if you're doing a conventional loan, and you're putting down between 97 and 95.1%. So you put your 3% down. The percentage of coverage you need is 35%. But if you do the specialized program that we offer through Fannie Mae, which is the Home Ready, or the Freddie Mac, the Home Possible, your coverage is less. So because you're doing this special program, you get a lower mortgage insurance rate, which means you're going to spend less money. To give you an idea how important credit is, I'm going to go over here to this side. So if you're putting 3% down and you needed the 35% coverage, and you have a 700 score, you're going to be paying 1.15% a month on your mortgage payment. Now, if I go over here to this Home Possible, you only need 25%. So that same person is going to pay 0.93% instead of 1.15. So you're going to save some money. In addition to that, you're going to save money because you have high scores. So look at this. If you're going to do the 25%, because you're going to do the Home Ready or the Home Possible, and you have 740 scores, you're only paying 0.63% per month. But let's compare that to somebody who has 640 score. You're going to be paying almost 3 times as much on your monthly mortgage insurance. And that's really important for you to know, because all you're doing is throwing away money. Now, there are some specialized programs that you can have. These loan programs are beneficial to new home buyers. You can, as long as you qualify for them, then it'll be okay. These are the loan programs that you can qualify for as a first-time home buyer. Some of them you don't even have to be a first-time home buyer, but conventional loan programs with 3% down, as I mentioned, Home Ready and Home Possible. FHA mortgages are 3.5%. VA is 0% down. If you're living out in the rural areas, or you could get a USDA or a rural housing loan with no money down. Jumbo mortgages you can do with 5% down. Those are very specialized loans. And if you're going to be in a doctor, if you're a doctor or a dentist or things like that, physical therapist, we have a great program that offers 100% on that with no mortgage insurance. So those are a couple of the products that are available out there. One of the things that we are lucky enough to have in the state of Illinois is a lender program for for down payment assistance program. It's by IDA, which is Illinois Housing Development Authority, and they offer a couple of different kind of loans. But the basic thing that you need to know is you have to be eligible for this, and there are 3 different types of loans. You don't have to be a first-time home buyer. You are eligible. And it's based on the county you're going to live in. And they do allow new construction loans. So here's the first one, the IDA Forgivable Mortgage. So this is an Access Forgivable. They'll give you 4% of the purchase price up to $6,000. And you can use that for down payment or closing cost, and it's forgiven over 10 years. So if you have your house for 10 years and 1 day, you never have to pay that back. If you do, sell it before then there's an amortization schedule that's followed. But it's a gift. You don't have to repay it. It's great. You can do it on a 30-year fixed mortgage and very affordable interest rates. Now, obviously, if they're giving you money, it's going to be a little higher than the normal rates, but there are benefits for both. You can do it for a VA, an FHA, USDA, things like that. And like I said, it's first-time buyers or a repeat buyer. So it's okay for you to do that. The second one is the Access Deferred. This is a little different. They're going to give you 5% up to $7,500, and you can apply it to your closing cost and so forth. But this is an interest-free loan, and it's deferred for the life of the mortgage. You don't need to repay it until you sell the property, which is awesome. So they're giving you $7,500 to put down, and you're not paying any interest for it. All you have to do is pay it back to them when you sell your house. That's a nice program. The Access Repayable program is they'll give you 10% up to $10,000. And you can use this, again, for your down payment or closing cost. And it is interest-free, repaid monthly over a 10-year period. I mean, you can't beat that. That's pretty good program to deal with. Again, you can use it to any of the programs, the FHA, VA, USDA, conventional, whichever you want. Now, for doctors, this is I mentioned to you, physician loans. Not everybody can take advantage of this, but We look at your income, and it's usually 50% of your gross. The debt to income. So, when I look at debt to income, that's your housing payment and your minimum payments on your credit cards and car payments. That could be 50% of your gross income. We don't have to count your student loans against you, which is amazing. And the down payment is zero, so you don't have to put any money down. And there's no mortgage insurance. So if you're going to be a doctor in Illinois or a dentist or a physical therapist, this is a great program for you, and this is available anytime, that you're going to be purchasing a home. Now, I want to show you a little about the contract itself. And I'm going to go through this very briefly. It's going to have your name and the seller's name. And the most important piece is, what is the address? Where, what are you getting for this? It's commonly known as. So if it's a quarter of an acre, it's going to be put in here. Address is 342 North Lincoln in Downers Grove. This will all be dictated. The property, a permanent identification number, identifies that house, and then they'll check all the information, whether it's a single family, detached, multi-unit, and so forth. The purchase price is going to go right here, and then any of the closing cost credits. So if you ask the seller to pay $5,000 towards your closing cost, it's going to be stated right here. And on every single one of these, the buyer and the seller will all sign an initial each page. Next is closing date. This is important because you're going to need to know when you're going to close. The financing, what type of financing you're going to get. And when you look down here, most people are not going to pay cash, but if you're paying cash and no mortgage, it's going to be right here in the contract. Some of the other things, obviously, are the statutory disclosures. Everybody has to disclose everything when it comes to the property itself, and the general taxes on the property. So usually in Illinois, the seller is going to give you 105% of last year's taxes, because when you're buying a home, you're paying things in the rears. When you're renting, you pay it on August 1st, it's for the month of August. If you're paying a mortgage on August 1st, it's for the previous month. Okay? They're going to go through the attorney review time, so the attorneys are going to go through, and this is why I said it's really important for you to know, the aspects of dealing with a real estate attorney, because they know these things versus some of them may or may not know it. And again, homeowners insurance, everybody has to have homeowners insurance. If you have a condo, they have insurance on the property in addition to you having a property insured on the inside. Title, seller's going to give you title to the property and make sure that there's no liens on the property. It's free and clear. And these are the things that your attorney's going to make sure it's all going to be done. Plat a survey. You need to know whether the property is, what are your limits on it? Do you have a 25 by 100 yard? Is there any problems with it? Are you over your neighbor's yard? Is there a fence? That'll all be on the plat a survey. Additionally, you're not going to need to worry too much about this, but again, this is where your attorney and your real estate agent come into helping you with this. Especially when your real estate agent's doing this, they'll go through this line by line with you. And then the last page is going to show everybody's information, your signatures, the seller's information, the buyer's broker, so it'll be their real estate agents, and the seller's brokerage information. All of that will be shown here. Your mortgage company, your attorney, the seller's attorney, loan officer you're working with, the association name, everything is spelled out so everybody knows exactly what you need to know when you're, who's buying it and who's responsible for what. Now, there's always some do's and don'ts when you're purchasing a home. So the first thing you need to know, and I keep stressing this over and over and over, you need to deal with a licensed professional, whether it's a real estate agent, an attorney, lender. They are all educated. They need to know what they're doing and have the ability to do the job. Secondly, consult with your mortgage professional first, because you really need to know what you're going to be qualified for so your agent can go out and find what you can afford. There's nothing worse than going out looking for a house for $300,000 when you can only afford $250,000. You're going to be very, very disappointed. You want to keep your monthly obligations within your financial means. In addition to that, you're also going to put, and I always say this, get a list, get a sheet of paper, draw a line down the middle, put your list of wants on the left side and your needs on the right side, or vice versa, because you're going to have to buy a home that has your needs, and if they have your wants, that's great, but you have to have your needs. So when you're looking at don'ts, don't go out and buy something or open a credit card beforehand before you buy, because you're going to change the picture of what you're doing. So if you're going to go out and buy an automobile or car, motorcycle, it's going to lower your purchasing ability, because now your debts are going to be different than what they were before. Don't go out and have anybody run your credit. So if you're going to talk to a lender, don't just have each one of them run your credit. Don't go out and open new credit cards or go out and buy the car. And don't overextend yourself. That's really important, because you're going to be making these payments on this mortgage for a long time. And if you can't afford it today, you're certainly not going to afford it next year. Make sure that you know all the costs that you're going to incur, and that's why we do the loan estimate. That's why all lenders go through that. And one thing that you need to know is we always trail funds. So what you need to do is you need to discuss any large deposits going to be going into your account, or if you're transferring funds, or if you have any cash that you're dealing with, talk to your lender first. They'll give you the best idea of how to use that. Annualcreditreport.com, and I bring this up because everybody has free access to your credit. Yes, you can go to Credit Karma and sign up and do that and get it free. But Annualcreditreport.com was set up by the Federal Trade Commission. They actually dictated the fact that since you are a consumer, you have a right to your credit report. And since there are some credit bureaus out there that report this, or get all the information from the creditors, it's their obligation to be able to give it to you to make sure it's correct. So you can go to annualcreditreport.com and you can get a free credit report from each of the bureaus every year. So I might suggest, if you want, get one ahead of time from all bureaus. And then each year, do one every 4 months. Do one 4 months later, go do the next one. The next one is 4 months later. Now you've gotten 12 months. Now you can then start again. Because most creditors reply or report to all bureaus, but you really need to know what's on there. And you need to know that the credit scores are not that important. Don't buy the credit scores, because your lender is going to have to run their own credit report, and they're much different than when you get the raw scores from the credit bureaus. So there's no sense of you paying for that. The other is, since the credit bureaus can have your information, they can sell your information. And this is one of the most widely known things. You always get junk mail. You wonder, well, why am I on this list? Why am I getting these offers? Well, the government said that you have a right to opt out of that. So you can tell the credit companies that they can't sell your information to anybody. So for instance, if I wanted to buy your information, I could go to the bureaus and say, I'd like to buy people who have 740 or higher scores, who make 100,000 or more, who live in DuPage County. And I can buy that. And unless you tell them, you can't. So you go to optoutprescreen.com, or you can make the phone call to 888-567-8688, which is 888-5-OPT-OUT. And you can opt out of this for 5 years. And then 4 years and 9 months, go in and do it again. So it really helps you, unless you really like junk mail. I think this is something that's very, very important for you. And I suggest that you do it before you start shopping for a home and working with lenders, because once you run that, then they can start selling it, and it's already there. So I think that's really important. Two things for you that we can offer you. There's added benefits for homeowners. So anybody that's going to be doing a mortgage with Draper and Kramer, gets a benefit of working with this. We work with Genworth, who used to be GE, and they give us a participating company discount for a number of companies. So everybody that does a mortgage with us, we can give this information to you. You sign up, put your own code in, and they don't sell your information. That's one nice thing. Next is the app. So you can see if you wanted to actually download my app, you can either make a note of it here, www.dkmortgage.com/Hoffman/mobile app. You can go there and download the app. It can give you a great deal of ability to do a lot of the things that you want. You can actually search for homes. You can do calculations. You can scan and email things to me. So if we're doing a mortgage and I say, hey, listen, I need your W-2. I need your latest W-2, or I need your pay stub. You can take a picture of it through the app, and it comes right into our secured system. You don't even have to go to an email or a fax, anything like that. You'll get notifications every time that you get through the process. So once its application is taken, you can get that. Once the appraisal's done, you get that. So all the different pieces of it, you're notified, which is really a super thing. So I really appreciate all your time. I want to leave this up for a minute here. Draper and Kramer Mortgage Corp has a great deal of opportunities for you for loans. We loan in almost every state. I'm licensed in a number of states, and you can see my licensing down at the bottom. If you're licensed in a different state, if you want to purchase in a different state that I'm not licensed in, I will do it in relationship or correspondence with a loan officer that's licensed in our company. So you can go email me anytime at keith.hoffman@dkmortgage.com. My cell phone number is 630-306-5626, or you can visit my website at dkmortgage.com/Hoffman. So I hope this has been informative to you. If you would like, you're welcome to email me, and I'll be glad to send you a home buyer's home guide or hand guide. It's a guide to financing your home, and it really gives you a lot of information that's helpful. So if you'd like that, please just email me, and I'll be glad to get it out to you as soon as I can. If you have any questions, you can get in touch with me. And I just want to thank Sandra Price for allowing us to do this wonderful first-time homebuyer seminar or webinar. And we'll be doing one almost every week for the next month with different topics. So if you are interested, you can get back to us. You've got the location, or just email me and I'll send you the links to get on it. And in the meantime, I really appreciate your time and effort, and have a wonderful day or night.